Thank you for tuning in to Starkey Multifamily Podcast. Please like, share, and or give me a 5-star rating. It really does make a difference. I'm your host, Reed Starkey, and today I have with me Kyle Kovats. Kyle is a National Association of Realtors 30 under 30. He was at one time selling $15 to $16 million per year in real estate, residential. He owns a real estate school. He has flipped many houses, done subdivisions, even did some Airbnb with limited success on that one. And now he's into multifamily. I brought him on here today because he has passively invested $650,000 before he started doing his own multifamily. And we want to talk about what he looked for and what experiences he gained from that. So Kyle, let's start. How did you get involved in the passive? When did you start and how did that work?
So about a few years back, after doing a lot of, what I would call buying myself jobs. So when you're doing flips, doing subdivisions, doing Airbnb is like running a hotel. And I did, make a little bit of money with that, but the time was not worth it. So I wouldn't, listen, I think people could probably do a good job with that. But for me, very time consuming. So I own a real estate school and I'm a full-time realtor as well. So doing those things was just taking up too much time. So I started wanting to look into something where I could still invest in real estate because in my opinion, real estate investing is the best thing that you can invest in this country. But I didn't want to have to do the day-to-day grind of, whether it be, having to babysit, a contractor, having to clean up an apartment after somebody leaves on an Airbnb, hiring attorneys to do subdivision processes and things like that. I started looking into syndication, and syndication, passively investing in particular, I thought was a tremendous route. Basically, I find people who I know, like, and trust who are putting together, multifamily investments and take a look at their deals. If the deals look nice and the deals look good, I kind of just hand off my money and I sit back and just wait for checks to come in.
What was your first deal and how did that come about?
So first deal I did was a deal in San Antonio. It was a smaller deal. I actually wound up finding the guy from hearing him on a podcast. Deal's been going well. That's been for about 2.5 years now or so. Deal's been going well. It's producing about 8 to 9% cash on cash return, which is, typically what I look for. When I first started off, honestly, I didn't have a whole list of syndicators who were putting together deals. So I relied on podcasts like this to meet people who were syndicating deals and then scheduling phone calls with them and basically figuring out, what they looked for, what their criteria was, and, what the projected returns that they targeted were on deals. Wound up finding out through these podcasts, various events that I could go to where I could just meet more and more people who were syndicating deals. Just got put on more and more people's lists and, again, just started vetting sponsors, going through, deals that I got sent in my inbox and kind of took it from there, basically. So
was there something that made you decide to look for those? I mean, what said multifamily for you?
Yeah, so for me, I'm in real estate, so I see some of the returns that people have gotten, investing in multifamily. So I said to myself, these are great returns, but, and I would love to buy an apartment complex, but by myself, I don't have the money to buy an apartment complex. So I wanted to just get a piece of the action. And for me, the multifamily fundamentals are, it's always going to be there. I always, in my head, I think, can Amazon knock this out of the market? And the answer is no. Amazon's going to be able to deliver milk to your door within 5 minutes, in the next number of years. What Amazon can't do is Amazon can't deliver a roof over your head in 5 minutes. So the fundamentals of multifamily with, student loan debt going up, divorce rates going up, increasingly, you're having just more and more households being formed because, again, at the end of the day, you're having people who are renting for a longer period of time because they have so much debt. People are starting families later, getting married later. The fundamentals just made too much sense to me. So I'm 28 years old and all of my friends, are all renting. Very, very few of my friends own homes. So, and that's even friends who have gotten married as well. So just the fundamentals and, having the experience myself, seeing what my friends my age are doing, it's kind of sold me on multifamily.
What are some of the lessons you've learned with some deals? Are there some negatives you found out with different sponsors or?
Yeah, I've been fortunate. I've been blessed to, invest in a lot of great deals. I've really only invested in one deal that's gone bad. And Honestly, there was just a lot of issues with it. Issues from renovations not going according to plan. Issues with homeless people on the property. Issues with having to hire security staff. Just stuff like that. Now, part of this is my fault. I should have done more due diligence before handing money over to these sponsors who are putting together this deal. But overall, I would say I've had a pretty good experience. Lessons wise, people who have done deals, and you could just look at this, people who have done deals between 2011 to 2018, there was very few bad deals that were put together. So just relying strictly on somebody's track record, I don't know if it's always the best avenue because, again, if they did a deal that they closed in, let's say, 2013 and sold in, 2015, 16, 17, 18, odds are their investors made money on that deal. So, but again, was it because they were a good sponsor or it was because a rising tide raises all ships? So there's questions that you should be asking these people. Hey, what did you do to force appreciation on the property? Or did the return just come from the market doing well? So I want to see what they did capital renovations wise to, raise the rents, force appreciation. And, did they provide value or did the value come from the market just doing better? So, those are a couple of things that you want to ask because despite track record, if somebody's only been syndicating while the market's been good, you want to know where the return came from. Did the return come from just from the market doing well or from their performance?
That's a great point. So you had mentioned when we talked before here that you had some questions. Can you share those questions that you ask?
Yeah, absolutely. So I think I would say there's 13 questions I typically ask. I would say the number one question that you can ask to really get a good determining factor for whether a deal is a good deal or a bad deal to get into is, can I see the webinar? Because most people who are sponsoring deals are either doing webinars or phone calls. They should have a recording of that, hopefully. So can I see the webinar for the most recent deal that you sponsored? And can I see your most recent monthly report on that deal? And the reason I'm doing that is I want to see what do they typically present when they're raising equity for a deal versus how did that deal actually perform? In other words, I'm trying to compare and contrast what projections were versus what actuals are. So this way I know if I'm going on to this webinar to watch this deal that this person's raising equity for, should I be skeptical that they're going to probably try to overpromise because it's proven to me they've underdelivered, or they're the type where they've actually underpromised and overdelivered? So that's a great question I like to ask. I ask about deal structure, preferred returns or straight equity splits, things like that. I ask about acquisition fees. I'm not really a huge fan of acquisition fees. I understand a sponsor wanting to take one, that's a nominal amount because it is, it's a pain to put together a syndication, but sometimes you see somebody doing a $40 million acquisition fee and charging a 4%, 3% acquisition fee. And I'm thinking to myself, you're buying something for $40 million. You already outbid every other buyer who bid on this. And on top of this, you're asking your investors to pay 3% more on top of that, an extra $1.2 million, just because I was able to push a deal across the finish line before the deal even performs a dime. So I don't think that always aligns interest. Also, because let's say during the due diligence, a couple things pop up that might be grounds for saying, hey, we might want to think twice about this, or we might want to negotiate this credit, but the seller's holding steady on the credit. Does the sponsor say, hey, we got to really push this deal across the table because we close on this, we make 1.2 million? Or is the sponsor ethical? Now, part of this is also making sure you're vetting your sponsors too. So those are questions that I ask. Trying to think of some others. I'll pull up a list here. I ask people like, for instance, have you actually physically been to the property and done things like shop the comps? I want to make sure they didn't just underwrite the deal from across the country and they'd never visited the property, just kind of relying on what they think. I want to make sure they were actually physically there and they shopped the comps. Asking them about insurance. I think insurance is extremely important. I am invested in another deal in San Antonio with a tremendous sponsor, and it's a 309 unit property. There was a fire back in late March, early April. I forget when it was. It was in March or April, but the fire ripped through 24 units, an entire building. He issued us a distribution, a cash flow distribution 2 weeks after, despite having a fire rip through 24 units, because his insurance was phenomenal. He's very diligent. He's on top of everything. So he had insurance for debris removal, code upgrade insurance, business interruption insurance. So even though 24 units, burned down, and thank God that everybody was safe, nobody got hurt, he was able to issue a distribution check within 2 weeks after that, which I found extremely incredible. So that's somebody who, if he puts together a deal, it's basically like, hey, if I'm looking to place money passively, you got a deal, take my money, because I trust him. I do have some other questions too. So this might sound like a weird question, but I actually think it's a question that is important to ask. I ask sponsors if their family and friends are investing in a deal. And I know it might be a little weird of a question to ask, but the reason I ask this is because the people you least want to let down are your family and friends. So if your family and friends are investing into a deal, I think there's an extra level of accountability. And again, everybody should be held accountable, but if your friends and family's money is in this deal, I think there's an extra level of accountability on top of that. So I know it's a strange question when you hear it, but it's a question that I do like to ask though.
So that's an interesting point. What if, and maybe you haven't run into it, what if they're doing a 506C where it's accredited only and maybe their friends and family are not accredited?
Sure. Interesting. To be honest, I've never invested in a 506C, so I don't know. I've only invested in 506Bs because I kind of like, now granted, I could have friends who I know, like, and trust who do a 506C, who I've already vetted. But I do like to vet my sponsors. I do like to invest with people I know, like, and trust. So if it's somebody I don't know and I've never met before, they're doing a syndication, it's a 506C, I am accredited, but I'm probably just not going to jump right into that deal because I didn't get to know the person. Yeah, I do like to get to know the sponsor. I like to have conversations with them, see what they're about before I do invest. So I've never been put in that position because I've actually never invested in a 506C, only 506Bs.
So you talked a little bit about, vetting the deal, and then you said you vet the sponsor, but where do you start? Like, how do you look into that person and get an idea of who they are?
Yeah, for me, honestly, a lot of it is just literally meeting them and getting to know them and looking them in the eye. And I don't like look them in the eye and be like, all right, let's see, is this person a bullshitter? But I mean, what I mean by that is I just want to get to know them on a more personal level. So I want to go out to dinner with them. I want to have drinks with them. I just, want to shoot the shit with them, basically. So I want to see what they're about. And that's the first thing that I do. If I don't really if I get a vibe from somebody like I don't trust them off the bat, I'm probably not going to invest with them. I do like to just simply get to know people. So that's really the first step. After that is when I start going through these questions. And the first question you could start off with before somebody even has a deal, if you're just determining whether if they have a future deal you're going to invest with them, just ask them, what's the most recent deal you did? Can I have a copy of the webinar? And can I also have a copy of most recent monthly report? Because again, it's going to be something that's going to show you the actuals versus what their pro forma was. And you want to, again, kind of compare and contrast that.
You talked a little bit about the splits and the fees and so forth. What are some things that, like on the split, that you look for?
I personally look for straight equity splits. I'm not a fan of preferred returns. And the only reason I'm not a fan of preferred returns is because my concern is, let's say they're offering like an 8% preferred return, and in year one, they get me 4%. Well, that means in year two, they got to get me 12% to catch up. And my thought is, what if they can't catch up? Then they're really not making any money on the deal. And the money that they will make is at time of disposition, when they do eventually sell the property. So would that cause them to sell the property at an inopportune time if they've fallen so far behind on the pref where they are not, taking any cash flow besides maybe like an asset management fee as an example? So that's my one, real concern with the preferred return is if they start falling too far behind, does it disalign interest? Does it cause them to sell at a time that's, not really the best time to sell? I like straight equity splits where it's just straight. There's nothing else to it. No waterfall structure, things like that. Just a straight equity split. I'd like to see, 20-80 or below. So for example, 20, percent to the GP, 80% to the LP, or below. Asset management fee, hopefully no more than 2%, ideally. I'd also, would prefer if the asset manager is doing something with that asset management fee in regards to putting it back into the property, even if it's some little stuff. And I don't mean all of the asset management fee, but maybe even just a little to host like a 4th of July barbecue for the tenants, to have like an Easter bunny go around Easter and do like an Easter egg hunt for the tenants' kids, to do some kind of like Halloween thing, where there's like a trunk or treat, type of deal. So just basic stuff like that. I'm pretty big on community building. I think when sponsors build a community, within the apartment community. I think that increases retention, and I think tenant turnover is a cost not enough sponsors actually account for. So any measures that can be taken to increase retention and provide, a better quality of living for the tenants is something that I'm interested in. So if somebody is willing to reinvest part of their asset management fee into, doing things for the tenants, I do find that pretty valuable.
It's an interesting concept of returning the asset management fee in some way, shape, or form. I've never heard it done before, and I like it. And I like your point, and I want to go into it more because I think I know what your answer is going to be, but the 80-20 split and below or above, depending on how you want to look at it. But why? So you're saying, to clarify, you're saying the most that you would want to take is 80%. So like a 90-10 would be no good.
Well, no, 90-10 I'd be happy with, because 90-10 would mean that, only 10% is going to the GP, 90% to the LP. So I'd be cool with that. But, again, on a straight equity split. Now, if somebody were to do, like, let's say a 70-30 straight equity split, there better be some insane upside on this deal that nobody else on the planet knew about, because I call it a tax. It's a pretty high tax to pay as a limited partner when somebody's taking 30% of the total deal for being the GP on that deal. So I think at 20%, it's a fair shake. If somebody's willing to go lower, even better for me as an LP. I just want to, again, at the end of the day, you want to make sure the GP is providing value, though.
Okay, so I guess what I was thinking we were going to go, I guess the reason I was backwards on that with you is, so generally, so we look at it a little bit differently from a passive side, is the same way you look at the pref. If they're shrinking their portion down so much just to make the numbers work for me. So from a passive investor, you want the numbers to fit. You have your own criteria, which we'll have to ask you that later. But
right.
So you need a certain cash on cash, a certain IRR. But if they had to tweak their numbers so far, shrink their numbers so far to get you that scares me a little bit too from the passive side.
Yeah, I mean, I can tell you, I'm in a bunch of deals. One of the deals that I'm in right now, I passively invested in, closed in Fort Worth back in September. I have to check. I think that's a 1288 split, but I'm getting 13% cash on cash in year one on that deal, which is great. I mean, year one cash on cash, if I get 5-6%, I'm happy, because usually year one you're going through the capital plan and you're having more turnover, so usually there's less cash flow in year one. But I think, and this is another thing too, I think some people are a little reluctant as a passive investor to invest with a GP who's doing their first deal. I could tell you the two best deals I'm invested in were two first-time GPs, because I feel they charge a little bit less as far as that straight equity split. It might be 1486, might be 1288, something like that. Because when somebody's first starting off, if they're in this for the long haul, not in it to make a quick buck, the best way to build up repeat investors is to provide good returns. Provide good returns. If you take less money, yeah, you're taking less money on these first few deals, but you're proving yourself. You're showing that you are providing good returns. And so these two first-time sponsors who I invested with in, again, Fort Worth in September, and a deal in Lawrence, Kansas in September, that one closed as well. They're doing a great job. So when they do their next syndications and I'm looking to invest money passively, I've been in deals with them. I know them. I like them. I trust them. I've seen how they've performed. It's pretty much going to be, I'm just going to glance over their deal and say, hey, here's my money.
That's a valuable point. The credibility that you can grow and the repeat investors. It's not about just getting the one deal done and then you move on. It's imperative that you take care of those investors, because they're going to come back. And so that's a valuable point. And then they're going to have friends. If you have money, your friends usually have money. Your family usually has money. It's people with similar bank accounts usually hang out together. Right. It just is the way it is. And then so you're going to have more recommendations from there. Even if you have, and the key is kind of like you said, it's not when the property does good that you can really find out, because it could just be the economy went up so much that they did everything wrong but still gave you a profit. It's when things go wrong, are they communicating it with you? And And how quickly are they communicating those problems, and how quickly are they solving them? Are they taking actions, or so that's valuable. Now, you talked a little bit about, not to jump around, but you said the 13 questions, and I might have missed them. Did you read all 13?
I didn't read all 13. I can go through them now. So one of the first questions I ask is, is the GP putting their own money into a deal? And I want to know, are they putting their own money into the deal, or is the money that they're saying they're investing themselves coming from the acquisition fee? So if like the GP says, I'm investing $250,000 of my own money into this deal, but they're taking a $250,000 acquisition fee, they're really not putting any of their own money into that deal. Mm-hmm. So I want to make sure they have some skin in the game. They don't have to put a ton of their own money into the deal, but at the bare minimum, they should be investing the minimum investment in the deal. I always ask, is there an acquisition fee? Again, as I spoke about earlier, I'm not a huge fan of these large, outlandish acquisition fees, unless there's something that they did to get that deal that I don't know about. Maybe they got the deal off market. They were the only buyer to know about it, and they got it at a ridiculous discount. Okay, that makes sense. But if you're charging, again, like on a $40 million acquisition, let's say a 4% acquisition fee, you're basically, you outbid everybody. And now you're not only outbid everybody, but when you're in that price point, you're outbidding institutional money. And on top of that, you're asking your investors to pay an extra 1.6 to you, for just landing the deal and beating out everybody else. I don't think it aligns interests so well. I asked about the asset management fee. There's always going to be an asset management fee, hopefully 2% or less. And again, as I said, I want to see if they're going to be doing anything with that to put it back into the property. I ask about, is it a preferred rate of return or straight equity split? Talked about that earlier. I do prefer the straight equity split, hopefully no higher than 20% to the GP. I ask about, a time of sale. Now, very standard, obviously, that at time of sale, you as a limited partner, you're going to get your initial capital back before the GP touches anything. But I just like to ask that question. And I want to see at time of sale, is there going to be some kind of disposition fee, which is more or less just a commission for selling the property, typically above a certain price. But I just, I want to know that. I haven't been in any deals that have done disposition fees, but I'm sure I'll be in one eventually that has some kind of disposition fee to it. But if there is, I want to know what it is. As I spoke about earlier, I do ask the sponsors, have you actually physically visited the property and shopped the comps? I think it's important that they physically be there, not just underwrite it from across the country and just say, hey, I'm raising equity for this deal. I want to make sure they were actually there. I always ask, what's the number one concern you have with this deal? If they say, oh, we have no concerns, they're lying. Everybody has a concern when they do a deal. So maybe you have some kind of speculative other income that you're going to be doing. Maybe you want to start charging for reserved parking spots because some of the neighboring properties have that. Maybe that's a concern of yours that, hey, all the neighboring properties have it. We've just never done it here yet. So I am a little bit concerned. I'm hoping we'll be able to get this, but that's probably my number one concern on this deal. So things like that. So asking about, maybe they have a CapEx plan where they're spending $6,000 per door, and they're going to be resurfacing countertops. They're going to be repainting and glossing the cabinets, new brushed nickel hardware, new brushed nickel lighting fixtures, new appliance package, vinyl plank floors, new vanity, new backsplash, low flow toilets, low flow shower heads, things like that. Maybe it's in an area that they're going to be doing that first in. That hasn't been done at any other apartment communities. Maybe it's a concern that they won't be able to command the rent bump that they're thinking about. So I just want to see, because if they're being honest, they're going to have some concerns. I just want to see what concerns they do have. A very important question that I ask is, how did you come up with your number for property taxes? Depending on the state that you're in, property taxes could, make or break a deal. You could be doing a deal in, let's say, in Dallas or in Tarrant County, as an example, and maybe the current T12 property tax for $70,000. But after you buy it, after sale, the property tax might go up to $120,000. Well, if your underwriting just projected tax will go up to $75,000 because you're not from that area and you don't know how taxes work there, I mean that's a big screw up, because you just underestimated the property tax bill by $50,000. And for simple numbers in my head, at a 5% cap rate, that's $1 million mistake. So that's something I want to make sure that they've actually done their due diligence on the property taxes. I find the best way, ask your property management company. They should be able to tell you that. The brokers are always going to tell you they think the property tax will be a little bit lower than what they really will be. So ask your property management company because, again, at the end of the day, you're developing a good relationship with them, and they should be able to provide that type of information to you. The insurance I spoke about earlier, definitely really important question. Want to make sure that the property is properly insured. If I'm investing 100,000 into a deal, 150,000 into a deal with you, I want to make sure if like a fire happens, if a tornado happens, if a major flood or hurricane happens and the whole community or a portion of the community is destroyed, there is coverage for that. So is it actual cash value? Is it going to be replacement cost? Are you getting debris removal? Are you getting code upgrade insurance? Are you getting business interruption insurance? And how long is that good for? Is it good for 6 months, 12 months, 18 months? So these are questions I want to know. I just want to make sure that my capital I'm putting in the deal is protected against, some kind of potential natural disaster or fire or something like that. A question I always ask, because believe it or not, some sponsors that I've invested with, they don't tell you about all the upside on the deal because they don't want to get you too excited and then underdeliver. So I'll ask them this question privately, not in front of others. I'll say, what additional upside do you believe there is on this deal that you haven't spoken about yet? And usually it's one of those, all right, don't tell anybody I'm saying this, but here's what I think the additional upside would be. I just don't want to overpromise this to people. So I do ask that question because there might be some extra opportunities. They just aren't confident enough in those extra opportunities to kind of, explain those to the passive investors. But sometimes you'd be surprised how much additional upside there could be on a deal. So sometimes there's not, but I do ask that question in case there is. I ask what their relationship is with the property management company, and does the property management company manage similar properties locally? I want to know that because I want to know what the property management company's experience is in that area. I don't want a property management company who specializes in, A-class luxury apartments, managing like a C-class apartment in a blue-collar area. They're just not going to be a good fit for that property. And also, I want to make sure they manage other properties nearby so they know the area. So if they're getting their projections from the property management company, hey, this should cost like $4,000 a door to do these interior renovations that you want to do. Well, are they just guessing that, or have they done that on nearby properties? So I think it's important that they have a good local presence too. And again, as I spoke about earlier, what's the most recent deal that you did? And can I see the webinar for it? And can I see your most recent monthly report? Again, I want to kind of compare and contrast what was the projections versus what are the actuals there. And the last question, the weirdest question I said earlier, are any of your friends and family investing in this deal? And again, I just think there's an extra level of accountability with people when their friends and family actually invest in the deal.
I think those are good. So I had a couple of questions. So you talked about a disposition fee, which I've never seen it called a disposition fee. I've seen it a capital transaction fee. Have you not seen those either, or?
I've invested in any deals that have had them. When I've been on webinars, when I've heard sponsors talk about it on deals I haven't invested in, I've heard it referred to as a disposition fee. Maybe it's called that too. I've never invested in a deal that's had one, so I'm not all that familiar with it. I've only heard it on some webinars because I get on a bunch of webinars for people who are raising equity. I'm pretty picky in the deals that I do choose. I have certain investment criteria that I like to stick to, certain, space that I play in. I like B and C class workforce housing, nothing too fancy. I don't like luxury. I think they're overbuilding luxury in the country right now. So I focus in that B and C class space. I look for anything that can produce me an 8 to 10% cash on cash return over a 5-year hold. The average annualized return, honestly, I do look at it, but I don't put too much weight into it because a lot of that is dependent on external factors, macro factors, like where interest rates and cap rates go. I know a lot of people like to say, cap rates are not directly correlated to interest rates, but there is a correlation there. So when interest rates start going up, typically cap rates go up a little bit too. So if we do get into a point in time, which we eventually will, when interest rates start going up, cap rates, will eventually go up a little bit, I think at least. So I want to make sure that the sponsor has accounted for the fact that, yeah, you might have bought it at like a 5.5 cap, but don't project you're going to sell it at a 5.5 cap, because as time goes on, and ready to be more conservative and say, we bought it at a 5.5 cap, in 5 years, we're projecting we'll sell it at a 6.5 cap. I'd prefer that over them saying we're going to sell it again at a 5.5 cap. So just basic stuff like that. Those are, some of the things that, I keep in mind with my investment criteria.
So what about What about the risk of the deal? So a deal that maybe is taking on a bridge loan and a massive, renovation compared to a fairly stabilized deal that's going straight to agency debt. Do you take consideration into that? Do you have a preference one way or the other?
Definitely. I won't invest in a deal right now that has a bridge loan on it personally. I just don't like the concept of being, kind of stuck if you're in a bridge loan where you have a maturity date that are kind of under the gun for. What happens if your bridge loan's coming due and, lending is dried up? We're in a 14-month recession and lending is dried up. I just don't like the idea of that. I feel right now from a lot of the webinars that I've been on of, equity that's getting raised, I see bridge loans being used to make deals work that otherwise wouldn't work. And that's risky to me because a lot of these bridge loan deals I'm seeing put together, it seems to be, there's got to be some kind of coaching program out there that's teaching this structure, but it seems to be a 2-3 year bridge loan, 8% preferred return, like 15,000 in CapEx per door. So very, very speculative because you're buying a property that's not stabilized. It's under 90% occupancy, under 85% economic. You're going in there, you're trying to do all these, renovations that very well may work, right? So they very well may work. But there's a lot of speculation involved there. And on top of that, you're under the gun with a bridge loan. So I personally will only invest in deals that have long-term agency debt placed on them. 10, 12 year agency debt, Fannie, Freddie debt, stabilized property, 90% plus occupancy. So for me personally, it's less riskier and I prefer that.
So let's talk about the length of the hold then. You mentioned like 10, 12 year financing. Typically, I think from a passive investor, from the feedback I get, 5 years is optimal.
Mm-hmm.
But as you may know, when you run the numbers, the longer you hold it, the better those numbers look.
Mm-hmm.
Do you have a preference on when the expected exit is?
If I look at IRR, which accounts for the time that you've held the property for too, IRR is an important number to look at because yeah, you're right. If you do hold a deal for 10 years and you put 100 grand into it, if you get, your 100 turns into 200, you doubled your money, but it took 10 years and that's a 10% average annualized return in your IRR. I don't have a calculator in front of me right now, but I would assume it's probably closer to 5% on something like that. So that's not a great deal. The thing is, though, when you're getting into a deal that has 10, 12-year fixed rate agency debt on it, there's going to be a prepayment penalty, whether it be yield maintenance or step down. So you have to kind of walk a fine line there. If the deal's going to sell in year 2 and it was, let's say, a 10-year loan, there's going to be 8-year term left on it, but you've probably eaten up all the interest only at that point in time. So the loan's not going to be as attractive to somebody for an assumption. But, let's say your prepayment penalty on that is, I don't know, let's say 600 grand. It could really eat into the return. So you might, as the sponsor, have to find somebody who will assume that, which might in turn cause you to sell for a little less price. But if the return's good, when you take all that into account, you still do it, right? So, but yeah, the longer you do hold it, sure, the total return number comes out larger, but I more so look at IRR.
So if someone brings you, well, let's talk about those numbers first. So what IRR do you look for? Cash on cash, total return. So you said IRR is probably the most important to you.
Yeah, well, for me, actually, I would say cash on cash is probably the most important. IRR is second. Cash on cash, the reason why that's most important to me is because it's predictable. I like to buy for cash flow. If a deal's cash flowing, it's a good, steady asset. Times are good, times are bad, cash flow is coming in. A lot of the return on the back end is really out of your hands. It's just macro market controlled. So with the IRR, with the average annualized return, chunk of that is going to come from what happened overall macro in the market. So what would be ideal for IRR? Would be ideal is anything probably higher than 13, 14%. But again, a lot of that is dependent on things that are out of your control, both as the GP and as the LP, on what goes on in the macro market. So I would say ideally, you want to be over 13% for IRR, 14%, somewhere in that ballpark. But again, I also keep in mind that it's nothing that the GP can really control. because a lot of that comes into what has happened in the macro market. So cash flow, I think, is the one thing they can control, and that's where I look the most.
What numbers on cash flow or cash on cash do you look for?
I look for anywhere between 8 to 10% on average on a 5-year hold. So if I can get higher, get higher. As I told you, I'm in one deal in Fort Worth right now that in year one is producing 13% cash on cash return. So that's really good. I don't anticipate that. So that deal's going phenomenal. But if I can just get, a steady 8 to 10% cash on cash, that's a good deal for me.
Are you comfortable talking about the deal that didn't do well? Can we ask details on that one, or you want to keep that private?
What the details are. So I don't want to talk about who the people are who put the deal together or anything.
No.
Because they're good guys. They are good guys. I like the guys. There was just not enough due diligence done on the deal, unfortunately. So they're good guys. I like the guys. I have no problem with them. They should have done a little bit more due diligence on that. As I said, that's probably the biggest issue, not doing enough due diligence, not spending enough time at the property. So if I'm the GP on a deal, I'm going to go to the property at all different times of the day, when we're in the acquisition process and the due diligence process. I want to see what is it like in the morning, what's it like in the afternoon, what's it like at night, what's it like at those weird hours in the morning, like the 2 a.m. I want to see what's going on there. Is there people drinking outside, hanging out on cars at 2 a.m.? That's probably not a community I want to invest in. Is it 9 o'clock in the morning and the parking lot's full? Nobody's probably working then. So these are things that I like to do. And I think if these sponsors had kind of done that up front, they would have seen the homeless people living at the property. They would have known they probably needed some security staff. They would have known that it's a little rougher community than they thought. So just little stuff like that, because for instance, when I'm a GP on a deal, I do some informal due diligence. I just spend time at the property. I'll go dressed up. I'm 28 years old, so I'll go dressed up as I'm just a regular tenant there. I'll just walk around. I don't wear anything fancy. I'll wear a pair of mesh shorts and a t-shirt, just so I want to kind of fit in with the community there and walk around, so I don't stick out. I don't go dressed in a suit and they're like, who's this guy in a suit walking around this place? So I just walk around. I'll walk around the nearby areas, just generally walking around. I'll walk to the nearest liquor store. I'll walk to the nearest supermarket. So to give you an example, if I walk into the supermarket and I'm thinking this community right here, I can go in and spend whatever amount of money per door, and I think we can convert this C class as more of a B+ asset. But I go into the supermarket and it's basically guys who are in there with just long grown out beards, and not to be a stylish beard, more of a I drank for 2 weeks straight and I forgot to shave for 2 weeks type of beard. Yeah. I want to see what is it like there? Is that guy going to care if I put in granite, if I put in quartz, if I put in Carrara marble, if I put in stainless steel appliances, or does that guy just want a refrigerator that's going to cool his beer within 5 minutes? So you want to really get a feel for that. And the best way you can do it, go to the most nearby supermarket. It gives you a good, really feel for, okay, what is this area comprised of? What are the demographics? Older, younger, races, creeds, colors, national origin. Again, you could get a good feel generally for that area. You'll be able to find that stuff out through the census, but having boots on the ground and actually going there and just interacting with people, I think is a really good thing to do.
That's valuable. So let's talk about how you transitioned into being a general partner and a sponsor yourself. So you've done all your passive investing and you say, I'm ready to do my own deal. How did that happen? Did you find one, or were you actively looking for one, or how did that happen?
So so I'm a part of a mentorship program, Brad Sumrok, based out of Dallas. And through that group, there's probably close to 1,000 people in there, a lot of which are passive investors only, some of which are GPs. So I basically, after getting to know people, I reached out to a couple people and I said, hey, I'd love to go after a deal with you if you are finding a deal. So these two guys, Brent and Randy, found a great deal in Phoenix that I really liked, and they'd shot it over to me. And I said, hey, you guys need another partner on this deal, because I would really love to join this deal. I want to place a lot of capital myself in it, and I think I have a lot of friends, family members, and associates who would want to do so as well. And they said, we actually, are looking for another partner if you want to join us on the GP side. So I joined them on the GP side. I have, my father lived in actually Phoenix for a little bit. The deal was in Phoenix. My father lived out there for a little bit. I have a very close family friend who's out there. So booked a flight out there before I committed to them. I liked all the underwriting. I liked everything like that. Booked the flight out there, visited the property, met with the prospective property manager, toured the property, toured all the comps, did my walking around of the area and things like that, all the weird stuff that I do. And, I committed to them at that point in time. And I said, hey, I'm in. Let's do it. So I ended up doing that deal, and deal's been doing great. So we project it's predominantly, well, it's all 2 and 3 bedroom units, predominantly 3 bedrooms. It's 120 units. About close to 90 of them are 3 bedrooms, and around 30-ish of them are 2 bedrooms. And we're already above pro forma rents in year one. The surrounding area, I don't know if you've read any about Phoenix right now, but Phoenix is just on fire. Rents are going up, population moving in. It's the fundamentals are absolutely phenomenal there right now. So we're already ahead of projections, and the deal's doing really good. That deal closed on, I think it was February 22nd. 222, I believe it was. So, but yeah, so that deal is doing well. And yeah, I mean, the whole key when you're, first starting off is you're not going to do a deal probably by yourself. Like your first syndication, you're going to want to partner up with other people. And even if it's not your first syndication, I think partnering up with other people is valuable too. Find people like, and trust. Find people their track record. Find people who complement you as far as complementing your skill set. So Brent, as an example, on this deal, he is an engineer, and he's overseen billion-dollar construction projects engineering-wise. Randy flips tons of houses. Randy flips in some years like close to 100 houses. So really, really strong construction and engineering background, very analytical, very go-getter, and then we all kind of complement each other. And you want to find people whose skill sets are different than yours. You don't just want to pair up with somebody who has the identical skill set as you. If you do that, you guys really aren't going to be able to help each other, and you're probably going to butt heads a little bit
too. Interesting. So I like your aspect on partnering. I think it's critical. This is not like flipping a house where you have 100,000 and you can make it happen, or 200, depending on your market. But you can get into flipping a house or doing single family rentals rather cheap, and there's no need for partners because it's just small scale. But you're right, when you start getting into multi-million-dollar raises and property management companies, you need more than one person. It's not just a simple flip a switch deal.
Right.
So I agree. So what are your plans in the future? Where are you going, and where is this going to take you?
So I'm targeting deals right now on the GP side in Central Florida, the I-4 corridor, Orlando, Lakeland, Tampa, those areas there. I'm actually going to be spending a lot more time in that area. My girlfriend actually just got a promotion through work and a job transfer to Orlando, so she's actually moving down there. So there's going to be a lot of weeks where I'm spending like Thursday through Sunday down there. Really a lot of weeks. Almost every week for the most part, but I'm still going to be in New Jersey, every single week because I own a real estate school up here. I still sell homes up here as a realtor. I'm going to be back every Sunday to work with my clients, as far as, doing open houses, showing houses, things like that. But I'm going to be down there and have boots on the ground. I'm going to get to know those markets really well, and going to be looking to invest both, actively and passively in those markets, because now that I'll have a foothold there, I'll be able to get to know the area, a lot better than I would, living in New Jersey.
Yeah, that's great. So, so you're looking to take on mostly the general partnership side, and then maybe some limited partner as well.
Yeah, I'm going to do a little bit of both. If I see a good deal that comes across my desk and I have some cash laying around that I need to invest, I'm not opposed to still investing passively. I'm still going to be investing passively. So, and the tax deductions are certainly phenomenal too. I like those a lot.
I'm sure, yeah. So Kyle, how can somebody get a hold of you if they need to reach out to you?
If somebody wants to get in touch with me, they could just email me. My email is just my name. It's kylekovats@gmail.com. And you can always shoot me a text if you want to, chat sometime. I'll give you my cell phone number. It's 201-403-1314. I'm a realtor, so I'm used to getting random calls all day.
Very good. So if you want to list your house in New Jersey, is it?
Yeah, New Jersey.
So you can reach out to them as well. And then I guess you got your own realtor agents training, right?
Yeah, so we have a real estate school up here in Bergen County in Maywood. Kovats Real Estate School, my grandfather started it in 1973. He passed away in 2014, and I've been the lead instructor and director since that time. So I, teach all the pre-license classes. So I was actually teaching today until 2 o'clock, and I got to teach again tonight at 7 o'clock.
That's crazy. Well, you're definitely a busy person, that's for sure. So, well, thank you, Kyle. I appreciate you coming out or reserving the time to talk, and we'll look forward to talking to you again.
Yeah, thanks for having me on. I really appreciate it, Reed.
All right, thank you, Kyle.
Take care.
Bye.